All attendees are in listen-only mode.
Good afternoon. Welcome to Balance Sheet Analytics, a focus on accruals. This is the first of 4 in our series on financial statement fraud. Our speaker today is Jeremy Clompton, a Senior Managing Consultant with BKD, the Forensic Evaluation Services Division. He specializes in data analytics with applications in fraud prevention and detection, risk assessment, and business intelligence. And he is going to share some of that intelligence with us today. If you have any questions, you can go ahead and put them in the questions box on the right-hand side of your screen. We will be recording this webcast and we will email it to you. You should expect to receive an email with a link to the recording by Monday or Tuesday. Since we have a short webcast today, I don't want to take up any more of your time. I'm going to turn it over to Jeremy. Hello, Jeremy.
Hi, Lindsay. Thanks so much.
Oh, you're
And
welcome.
good afternoon and good morning to everyone, depending on where you're located. Glad that you could join us today. We're going to be talking, as Lindsay said, about balance sheet analytics, and we're really going to focus mainly on the accrual side. So our series that we're going to be doing is a 4-part series focused on the financial statements and fraud risk within the financials. This will be our main area of focus in the balance sheet is on the accruals. And while accruals aren't always discussed when it comes to financial statement fraud, there are still quite a few fraud cases out there that you can find related to accruals. One that is probably higher profile than most occurred in the mid to late 2000s, and if you look at that, that was the Nortel Networks fraud. And what was being accused there is that they were essentially using accruals to accelerate profits or even to decelerate profits. So to really actually address whether or not they were hitting their numbers or if they were performing a little bit too well, maybe to temper those expectations just a little bit. So with that, today we're going to talk about how we can focus on the accruals to address those risks, and we're going to hit 4 main areas within accruals. As Lindsay said, this is a fairly short webinar, so we have about 15 minutes of content, and then I'm going to allow time for Q&A. And what we're going to focus on first is the omission of liabilities. We'll talk about how that can impact the financial statements and can be used fraudulently. We'll also talk about overstating liabilities, which is one that doesn't necessarily sound intuitive, but it is a scheme that we see from time to time. We'll talk about how the timing of entries can play a role, as well as something that I refer to as a nonsensical entry, so an entry that just really does not make any sense whatsoever. And the approach that we're going to take as we progress through each topic is we're going to talk about each one, how it can be used in a fraud scheme, detection methods that you can use, a quick visual kind of drive it home a little bit, and then a live example of how we can accomplish that testing, or at least a component of that testing, an idea. So with that, let's go ahead and get started. The first item we want to talk about here is the omission of liabilities. And traditionally, the way that we've seen this used in fraud schemes is to actually overstate the performance of an organization or a company, typically the revenue side. That is most commonly why we see the omission of liabilities, because traditionally, especially as it relates to accruals, when you omit an accrued liability, you're also omitting an expense side item. So it's going to make the revenues look a little bit better. The other way that you can do that is by recording revenue that should be deferred as actual revenue, and again, that helps to overstate the revenue and reduce the liabilities. The other way that we see this being used relates to meeting loan covenants. So if we're looking at our current ratio or even our debt to equity ratio, the more that we can take those liabilities down, it's really going to help improve some of those ratios and help us to meet covenants, and it can help improve appearance. And one of the easiest ways to look for the omission of liabilities is really doing what's a traditional audit step, the search for unrecorded liabilities. And traditionally we've seen that done in a sampling method where somebody will take the subsequent disbursements journal, pick some of the high dollar items and look and see were those recorded at year end, yes or no, in the accounts payable detail, and really should they have been recorded. So what we're going to do here, though, is we're actually going to take a much larger approach, or a much broader approach to that, and search on a larger scale. And what we're going to do is essentially take the year-end payable register, get that in a detailed electronic format, load that into IDEA. We're also going to get all of the subsequent payments, so everything after year-end, so if it's maybe a month or 2 months after year-end, and we're going to join those together. And what we're really looking for there what are the payments made after year-end that don't show up in that year-end payable detail. And what we want to know then is, should they have been there? So the way that we can do this, a quick live demonstration, we'll jump into IDEA here. I've got an accounts payable detail loaded, and in this case we do have the voucher, a due date, some description. It's a basic accounts payable detail, pretty skinny down, but it's got a little bit of information there. The accounts payable check register, this is one that actually predates the year end and then goes past year end. So the first thing that we want to do here is we actually want to apply a quick criteria that says that the check date is after our year end, which in this case is going to be June 30th of 12. And we can see in this case that the check dates, we now have July 12 and after. We don't have any worries there. So what we're going to do is now go into our analysis ribbon, and we are going to join, based on the voucher ID, our accounts payable checks back to our accounts payable detail. So to do that, we'll select our secondary database of AP detail. Our match is going to be on the voucher, because that's what we're going to look for there. And here what we're going to do, I'm going to call this unrecorded items. And I'm going to say that I want all the records without a secondary match. So give me everything that was issued subsequent to year end that doesn't appear in my accounts payable detail. We'll go ahead and click OK. And then if we sort our voucher amount, we'll go ahead and sort that descending. We can see those big dollar items that we can focus on. So rather than having a sample of all of our checks, now we can actually pull a sample of those checks that we know for a fact don't show up. So it makes that test a little bit more effective, and it gives us a greater chance of finding items that could be problematic. And again, we can even look at the voucher date and see that some of these do have voucher dates back prior to year end and probably should have shown up there for one reason or another. So that's one of the ways that we can look for the omission of liabilities. The next thing we want to talk about are overstating liabilities. And overstating liabilities, really it's done to benefit future periods. And the way that we see that is essentially getting extra liabilities, accrued liabilities, or maybe even deferred revenues on the books so that we can have what I'll refer to as a cookie jar for the rest of the year. So maybe performance was really good this quarter. We don't really want it to look that great, so not everybody thinks that it's getting above and beyond what we want. So what we will do is we'll go ahead and we'll just temper those expectations a little bit by pulling some of the revenue out and calling it deferred revenue. Some of the ways that we can look for that are unusual spikes in the accruals and how often are accruals occurring. If we have a pretty solid expectation that the accruals should be hitting maybe once a month, maybe 2 or 3 times a month, because we have a few different aspects that we're bringing into that specific account, we want to look for variance from that frequency. We'd also want to look at the timing. Are we pulling out revenue right at the end of a period, and if so, does that make sense? Or are we going in and it's actually a post-dated entry where we've passed the quarter end, we saw that we did really well, so now a month or 2 months later, now what we're going to do is we're actually going to go back in and get that back out and predate it to hit prior to the quarter end. So what exactly does that do? And I'll show you what we're talking about here. Essentially what we have is at period end, we would be moving our income statement. We would have some extra revenues or extra earnings there. At that point, we'd decide that we want to record it later, so we're essentially just going to move that revenue across to where that revenue becomes deferred. Then, once we have our deferred revenue and we've got the next period, that deferred revenue balance obviously will just carry forward and it becomes part of the next period's deferred revenue on the balance sheet. So then once we hit some tough times and we decide that, you know what, we actually need a little bit more revenue in the stream, let's go ahead and just reverse that back out. So what we can do is we see where accrued liabilities are actually used to shift revenue from one period to the other. So what does that look like back in IDEA? So what we would want to do is, in a journal entry detail, I'll go ahead and close a couple tabs here for us. What we would want to do is use a criteria, and it's going to be multi-part, and we're going to say that the account number in this case is our deferred revenue account, which I happen to know, so I'll go ahead and type that in. And what we're going to be doing is we're going to credit deferred revenue. So we're going to say that the credit isn't 0, or we want all instances where the first digit of the account number. So in this case, we're going to use the left function for that, and we're going to pull in the account number, where that first digit is a 4, so any revenue account, and we're going to be debiting that account. So essentially what we're going to do is take our entire general ledger and we're going to isolate just the credits to deferred revenue and the debits to a revenue account, which could indicate that shifting there at period end. And then we're going to do a summarization on that, and we're going to summarize on the journal entry ID. And I'm going to go ahead and total up both my debit and my credit fields, and I'll go ahead and hit OK for us. And we'll see that once we have that summarization complete, now we can go in and we have all of our various entries here, and I'm going to go in and I'm just going to say, give me the entries where the debit amount equals the credit amount, because that is going to be very important to us. What are all of those instances? And we can see here that we have 49 entries where we essentially had a revenue being flipped to a deferred revenue. And if we use the quick extract feature here, we can see that we have $1.1 million in this single entry that was essentially moved from our revenue accounts. So we have debits at the end of December, and then we have our deferred revenue added. So now later on we would essentially have $1.1 million of revenue that we could use should we fall on tough times and need a little bit more in the bank. The third item I wanted to mention here is the timing of entries, and really timing is all about the manipulation. How much are we manipulating the financials? And what we want to focus in on there is really, how does the date of the entry relate to other very important dates? Do we have a public filing that's due? Do we have covenants that need to be met? Is there a potential acquisition coming up? And we see that the accruals are being changed near an acquisition. So consider all of those other key dates that you may have going on in your organization and look at how the accruals fluctuate relative to those key dates. The other things that we might want to focus in on are traditional red flags. The traditional red flags for dates that just don't make sense. So entries made on a weekend or on a holiday or somebody coming in after hours that's going to have to be making entries that they just don't make sense that they be made at that time. So again, back in idea, one of the things that we might want to do is simply look for all of the items that aren't on a workday. So we can use our workday function, and I have a date field down here, and I'm going to say that my workday is 0, and that will essentially pull for me then all of the entries that occurred on a Saturday or a Sunday. And it's very important to look at the type of entry as well. If you look at the journal entry ID, you'll want to make sure that you're not pulling automated entries that occur on a Saturday or a Sunday, because those could be very standard. Rather, you probably want to focus more in on those that have a JE type or whatever your manual journal entries are in your organization, because those are the ones that are typically requiring human intervention, and you have an individual that's actually in there making an entry either on a weekend or on a holiday, which would warrant quite a bit more follow-up. And just like anything that we talk about here, we're not talking that everything that falls off on one of these lists is instantly fraudulent by any stretch of the imagination. More so that it's an area that we need to follow up on a little bit further. Now the fourth item, and this is one that I know personally I think it is a very beneficial analysis, and it applies in a lot of different areas. I'm going to mention accruals, but a couple other areas as well. But non-sensical entries are really looking for any of those entries that just flat don't make sense based on the different types of accounts that are involved. So if we're trying to create revenue, that's what we might do. I'm going to show an example of that. It can also be used to hide things. An example that I'm not going to go over here would be a credit to cash and a debit to bad debt expense. So essentially, we took cash out and we wrote it off as a bad debt. That can sometimes be used to hide theft. In this case, what we're going to be doing is looking for entries that just don't make sense. And the example that I want to give you here for this is going to deal with specifically the accrued liabilities. So essentially what we have is here at period end, we decide that we're going to just book an extra accrual. We don't really need it. We don't really have a specific expense that it ties to, but we just want to book this extra accrual in the event we're going to need some earnings in the future. So we started off with one set of accrued liabilities. Now we've got two buckets of it on the balance sheet. The next period begins, and naturally our balance sheet's going to go ahead and it's going to flow through. So we have all of these extra accrued liabilities. So now, again, when we hit tough times, all we have to do is reach into the cookie jar, and we're going to reverse accrued liabilities directly to income. And that really doesn't make sense in very many instances. About the only one is a deferred revenue to revenue instance, but accrued liabilities themselves, or specific accrued liabilities other than deferred revenue, it would not make sense for that. So what we're going to do here is we're going to go back into IDEA. And again, what we're going to do is apply a criteria that says that if the account number is our accrued liabilities account and the debit isn't 0, so we are debiting our accrued liabilities, or, and again we'll use the left function here to pull out the first digit of our account number, and it's a revenue account, so a 4, and the credit doesn't equal 0, I want to see all of those. I would like to have all of those entries because that is a combination that in no scenario in my organization does that make sense. So what we're going to do then is we're going to go ahead and summarize again on our journal entry ID. We'll click OK. Oop, I apologize. When we do our summarization, we need to make sure that we do subtotal our debits and our credits, because much like what we did previously related to deferred revenues, now we want to know, do we have any entries where the debits and the credits offset, which means that we had to have our credit to revenue and our debit to accrued liabilities, and in this case we don't have any. So that's a good sign. That's what we would not expect to see any of those in our organization. So again, the way to do that, it's really to identify first what is our unusual account combination. In this case, it was debit to accrued liabilities and direct offset to a revenue account, and then essentially build a test for that to identify specifically those entries that you would never expect to see in your organization. A couple quick closing comments, and I've got questions here that I'll go ahead and answer. Thank you for everybody for sending those in. When it comes to accruals, while they don't necessarily directly impact the bottom line or the income statement, they are still often used in financial statement frauds because they can be used to impact the income statement. We've seen it time and again, and they can also be used to help mask the performance of the company, whether it's good or whether it's bad. So with that, I'm going to go ahead and open it up to a couple questions here. One of the questions relates to the search for unrecorded liabilities. How would you suggest doing that search if the checks are combined on multiple invoices, if the checks combine multiple invoices on payments? And one way that you can approach that is if you have the ability to get that information as to what the checks are paying. So going back to maybe the underlying table that generated the checks and get that detail as to what invoices were paid, go ahead and compare that detail back. Otherwise, what you might want to do is, just to get started, is to actually go ahead and do that as a dollar value. So here, by vendor, here's my total dollar value of AP, here's my total dollar value of subsequent payments. Once you get the total dollar value of subsequent payments, if it far exceeds what's in AP, at that point you can use that to kind of focus your search a little bit more as well. Depending on whether or not you're internal or doing an external audit, is going to depend on what approach you specifically want to take. The next question is, what formats do you use to import data into IDEA, specifically PDF, CSV, and XLS? All of those formats I've used historically. I don't prefer to use PDF, but IDEA is probably one of the best solutions out there as far as importing PDF documents. The ability to go in and pull out that data is very intuitive, and it works out really well, generally speaking, as long as it's not just a scan or an image. But CSV files, Excel files, Access files, my personal favorite is a bar or a tab delimited file, but really all of those options will work within IDEA. Another question here, is this something they check for on every audit, and if so, how often do they find managed earnings? Whether or not it's something that every auditor checks for is going to vary by audit team, probably by accounting firm, and by client. Every audit is going to be a little bit different, so I don't know that I can answer that question very well. In addition to that, I do work in our forensics division, so I don't necessarily perform audits per se on a regular basis. We've got time for just a couple more questions. What are you asking for when getting the journal entry detail? For example, are you getting the journal entry database for the year? What exactly are you asking for? A lot of clients do have difficulty. I couldn't agree with you more. Clients do at times have difficulty getting the detail that you're requesting. My recommendation there is really, it's asking for, if you say a journal entry detail or a general ledger detail, a lot of times that can be confusing because we know what we're asking for, but somebody in an accounting department may have a different interpretation of that. Asking for something like a transaction listing by account, sometimes that can get you the detail that you're looking for, and really it's the same thing. It's just a different way to call it. So my recommendation would be talking with clients earlier rather than later in the process, and talking with them and just asking general questions before you even ask for a file. So, saying something like, if I wanted to see all the transactions in, the accrued liabilities account, what report do you have that would have that? And working with them to figure out, in their terminology, what they could provide you. How long does it take you to get the data ready for import? That's going to vary dependent on data type. Typically, I do most of my cleansing of data and data prep work actually within IDEA. I like to keep the data in its native format until it is actually imported into the software solution, and then from there go in and design fields that will help to normalize or prepare the data in any regard that I need to. So it's going to vary, but most of the work is actually done after the data has been imported. One final question. This goes back to to using PDFs in IDEA. What OCR software does IDEA use for PDFs, and how reliable is it? I'm going to say that, Lindsay, if I misstate anything, let me know. But I don't believe that IDEA is actually using the OCR software itself. The OCR software is typically built into the product that created the PDF file. So if you print something directly from Excel or Word to PDF, that OCR is done during the printing process. If you have something that's a scanned image, you'll actually need to use some software to OCR that PDF file prior to importing it into IDEA. What IDEA uses is something that reads that OCR'd, the OCR'd PDF file and brings that text in. So the actual rendering of the text occurs outside of IDEA. And Lindsay, if I misstated anything there, please let me know.
I believe that is correct.
And that really...
I will check with our tech team, and we'll get back with you, Robin.
Okay. All right, thank you for that. With that, we're kind of getting up close against our time. I'm going to go ahead and mention that we do have 3 more webinars on financial statement topics. We're going to be talking next about analytics for expenses. That'll be August 18th at 2 p.m. Central Time. Revenue-based analytics will follow on September 2nd at 2 p.m. Central Time, and then we'll wrap up the series talking about financial statement analytics from a global perspective, a bigger picture, not necessarily down in the GL detail, but at the financial statement level on September 16th, again at 2 p.m. Central. If you had any questions that I wasn't able to get to, or you want to talk offline about any questions, my information is now up on the screen. You can reach me by email at jclofton@bkd.com. I'm very active on social media, as Lindsay can tell you. I try to share as many tips, tricks, resources, articles, interesting things as I can relevant to data analytics, especially as it relates to fraud. On Twitter at J313, or you can find me on LinkedIn. Pretty easy to locate there. And with that, I'd like to thank everybody for joining. When Lindsay told me it was a sellout crowd, I was very excited to hear that. I think it's a great topic. I hope everybody found this useful, and I'll turn it back over to Lindsay.
Thank you, Jeremy, and again, thank everybody for joining us. We will be providing the slides and the recording of the webcast probably by Monday or Tuesday. You should expect to receive an email at that point. Again, if you have any questions, you can either email Jeremy directly or you can email me at lindsayf@automation.com, and I can either have somebody on the help desk help you out, or I can forward your question to Jeremy. Please join us for the rest of our series and have a great afternoon.
Thanks, everyone.
Thanks.